Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got a special guest with me today from Middlefield, the very first time, another portfolio manager from Middlefield, Robert Moffat. How are you, Robert? Nice to have you on.
I'm well, thanks. Thanks for having me on. Appreciate
Of,
it.
I appreciate your time. Today we're going to talk about a healthcare dividend ETF. So as you know, my channel is all about income-oriented investing. When it comes to healthcare, we got a lot of choices on the Canadian market, especially in the covered call sector. But this ETF is actually not a covered call ETF, but it has a pretty nice high dividend of over 5%, which we're going to talk about. So I am talking about, in case my audience is not familiar, the Middlefield Healthcare Dividend ETF, the stock symbol listed on the Canadian stock market as MHCD. This ETF's actually been around. I think maybe you converted it to a closed-end fund to the ETF, maybe, but the inception date is 2017, right?
Correct.
So if you
Yep.
could just confirm that, was it a closed-end fund before, or was it always an ETF?
Yeah, it was launched originally as a closed-end fund and then converted a couple years ago.
Okay, perfect. So I want to talk all about this ETF, but first, it's your first time on the channel. Tell me a little bit about yourself, Robert, your experience, and how's it going there at Middlefield?
Yeah, for sure. So, as you mentioned, I'm a portfolio manager here at Middlefield. I've been with the company for almost 8 years now and been in the industry for a better part of 10 years. Since I joined the firm, I've been pretty much exclusively focused on healthcare and real estate sectors. And before joining Middlefield, I was in a research role at GMP in Calgary, where I was born and raised. So I'm originally from Calgary, moved to Toronto a few years ago, and been with Middlefield ever since.
Okay.
Studied finance in university at Western. Coming right out of there, pursued my CFA, got that, and from a young age, knew I had a passion for investing and capital markets.
Awesome, awesome. So you're the main guy, you're the main portfolio manager or a portfolio manager on this ETF, right? Correct me if I'm wrong. So we're going to talk all about this ETF here. So let's start with just the general premise and idea behind this ETF. For what kind of investor is it designed for, why did you come up, or what are the objectives, is a better way of saying it, of this ETF?
Yeah, for sure. So MHCD is what I would describe as a diversified healthcare strategy. So
Okay.
I think when a lot of investors think about investing in healthcare, they think about household names like, just to list a few, J&J, Pfizer, United Health. Those are certainly companies that we look at and invest in, but there's a whole lot more to healthcare than just those big pharma stocks that you may be familiar with. So
Yeah.
we invest across the entire spectrum of the sector. That includes healthcare equipment and devices companies. It includes companies that are more focused on life science tools and research and development, biotech stocks, health insurers, even some seniors housing is in the portfolio. So, basically anything that is generating its revenue, core revenues from the healthcare sector is something that we would look at in this portfolio.
Yeah, and the breakdown is right there on your website. So, what you're talking about is really diversification within the healthcare industry. You have the breakdown here. And of course, there's a lot of companies, will recognize, like you talked about, J&J. There's AbbVie, L. Lilly, the really the big blue chip ones that we're all familiar with. But I noticed some other smaller ones, and let's talk about the stock selection. So, dividend is in the name of the ETF. So how do you go about your stock selection? Are you just going after the ones with the higher dividend yields? Is that a consideration in your stock selection? Tell me a little bit how you vet these companies and what goes into the portfolio, how you decide which ones go in.
Sure. So as you mentioned, as the name would suggest, the healthcare dividend fund, it does pay a distribution itself of over 5%. So
Yeah.
we do have a certain criteria to invest in companies that themselves pay dividends in order for us to earn that income that we're paying out to our investors. So over 80% of the portfolio, at least today, is invested in companies that pay a dividend.
Mm-hmm.
So that's not to say that 100% of the portfolio is dividend payers. We do have some, for example, the ninth biggest holding here, Boston Scientific. That's a large med tech company that is a great business, great company that I love, but it does not pay dividends. So there's a bit more of a growth focus with that sort of a name. But by and large, we're looking at companies that pay dividends, and especially companies that grow their dividends over time. And I wouldn't say we're just looking for companies with the highest yields. That's probably never a good strategy. Usually companies have a high dividend yield for a reason because the stock price has gone down. So
Right.
really we're looking for a combination of capital appreciation potential as well as some regular sources of dividend income.
Okay, most of the exposures from the U.S. I see, which is most of where the best healthcare companies are in the world. But you got a little bit of international, a little bit of Canada. I'm assuming that the Canada exposure would be something like a Chartwell, which is a REIT, and we do have a little bit in healthcare facilities and REITs here. So let's talk about the sector as a whole. So throughout my years of investing and experience, I always really thought, utilities and healthcare as really super defensive. But I kind of changed my mind a little bit in the last couple of years with the rates going up, because that does put pressure on the utility sector. Of course, everyone needs utilities and stuff like that, but utility sector hasn't been doing that well lately because of that. But to me, it looks like the healthcare sector really has been untouched by this. And I'm starting to think maybe healthcare is like just the ultimate and the only super defensive sector, like defensive all the time. Would you agree with that? What is your opinion? How do you see the healthcare sector?
Sure. So the way I would describe the defensiveness of healthcare is that the demand and the end market of healthcare is very defensive. So um, naturally, healthcare spending is growing. It's a needs-based product and service. It doesn't really matter what's going on in the business cycle or in the economy. People still need to consume healthcare products and services. And another big reason that it's such a steady demand profile is that oftentimes we don't pay for healthcare out of our pocket. It comes from the government or it comes from an insurance company, but
Hmm.
it's not a discretionary purchase decision that we have to make. So whenever we need something, see a doctor, get some medicine, have a procedure done, we just go and do it, and we don't really think too much about the cost in many instances. So that makes the demand very steady, very consistent, kind of tends to grow with the population. And then something that we've been talking about for many years, I think, is the demographic tailwinds that underpin healthcare. We've been talking about how the population is aging and how there's going to be all this growth in healthcare spending and many other things related to an aging population. But we're finally there. We're finally arriving at this demographic tailwind where, for example, baby boomers are turning 80 in the next couple of years for the first time. The population of folks over the age of 80 is supposed to increase by 50% over the next 10 years. So it's something that we've seen coming. We've been talking about it, but it's finally arrived. And that's very important in healthcare because people in those older demographics, they just inherently spend a lot more money per person on healthcare. So we really think that it is a very steady, predictable, growing demand profile. But that's not necessarily to say, and again, this kind of comes back to my earlier points on diversification. We're still looking for companies that are growing. We're still looking for companies that are innovating, coming out with new products, companies that are acquiring other businesses and growing. So there's a defensive demand element to it, but
Uh-huh.
there's also innovation and disruption and lots of exciting stuff going on as well.
Yeah, it's funny that you mentioned they're steadily growing. I was looking at the stock chart of the ETF, and that's exactly what it looks like. So let's talk a little bit about the ETF in detail. So this is an actively managed ETF. This is not a passive index ETF, which means the management fee is obviously going to be a lot higher. So you guys have it at 85 basis points. But if we look at the performance, I was pretty impressed by it. It's really great performance here. This is as of end of March, and you see you have 8.65% average annual since inception. And I was trying to look for an ETF to really compare it to on the Canadian market. I did find one from BMO ZHU, which is just an equal weight index based ETF that focuses on healthcare in the U.S. side. And the management fee is a lot lower. The dividend yield is even less than 1% as of this number here. But if we look at the performance, and obviously it's going to have a lot of the same stocks, but if we look at the performance, the 1 year, you guys have a much better 1 year, you have a much better 3 year, the 5 year is almost identical, and the since inception is higher. So higher management fee, but higher performance. What do you guys attribute that to? Is it just the active management component, do you think? Obviously, you guys know what you're doing in terms of stock picking. What would be your comments on that?
Yeah, I think the first thing to point to, you nailed it, would be our active management approach. So, ZHU, for example, is a passive product. And what you get with a passive product is whatever is in the underlying index or the benchmark at that time. So what we have the ability to do is do some thorough fundamental research, evaluate the prospects for a company and decide if we maybe want to own more or less than what the benchmark is going to give you. So our portfolio typically holds anywhere from 30 to 40 names. So we think that's a pretty good, a sweet spot for having high conviction concentration, but also enough diversification that no single stock is going to be driving the entire performance of the portfolio. So yeah, the ability to actively manage and really zero in on the best in breed companies within the sector is a key advantage for us. So I think that, you know, active management would be probably the biggest reason for our performance track records comparing to a passive product like this.
Okay, perfect. Yeah, and that's the Middlefield way, right? I hear that from the other products as well, that you have high conviction in certain names, and that's why you see it's not equal weight, and a lot of the names have, you know, much higher percentage than the others. But you could actually go, and I'm talking to my audience here. If you go to the documents, and you could actually see the whole portfolio if you look for that in the documents portfolio summary. So just curious, this guy, Dr. Richard Evans, it says he's an industry advisor. Can you just explain his role within this fund?
Yeah, for sure. So we partnered with Dr. Evans right at the inception of this fund back in 2016, actually, I think was the initial launch date. And Dr. Evans is, before launching his advisory business, which is called SSR, it's an independent research advisory shop.
Okay.
But before that, Richard Evans was a sell-side analyst at Sanford Bernstein. He was also an executive at Roche, which is a large pharma company in Switzerland. So he has decades of industry experience and basically went on his own a few years and launched an independent research advisory business. So Middlefield has an exclusive relationship with Richard in Canada. Many of the clients, Richard does a lot of really great work on, especially I would point to healthcare policy and legislation. That's a really difficult area to navigate sometimes. So he's really helpful in helping us kind of stick handle through that landscape. And he's also an expert, has some of the foremost data on drug pricing in the entire industry. So his
Okay.
firm provides drug pricing data to many of his clients. So having Richard on our bench is an invaluable asset. I speak with Richard frequently, basically twice a month. We have a regular phone call, and I just basically have the opportunity to ask him whatever's on my mind, whatever's come up over the previous 2 weeks. And he's a great sounding board and a great resource for us to help navigate what is a fairly challenging sector at times.
Interesting. Okay, cool. Good to know. And the last couple of questions about the ETF in particular. Obviously, my audience is going to be interested very much in the dividends, the dividend yield. So the dividend is 5 cents a month, which is 60 cents annually, translate to a yield of just over 5%, which is pretty good. And we know that the healthcare sector is very underrepresented in Canada. So over 5% yield, which is great, which is just maybe, compared to a covered call ETF is maybe 2 or 3% less. But if we look at the stock chart, this is since the inception, you see a pretty nice, steady, growing stock chart. So you see like plus 15% here all time, plus the dividend yield. So obviously this ETF is performing really, really well. So just to confirm, you guys, like Shane with the innovation ETF, are you guys, there's no leverage here? So if you just confirm that this is not a leveraged ETF?
Correct. No leverage.
Leverage?
Long will be up to 100% invested, but yeah, no leverage.
Okay. What about covered calls? Do you guys do covered calls? Do you do it tactically? Do you have the ability to do covered calls on this portfolio, or you just say no covered calls? We want the organic growth of the stocks.
Yep. So we do have the ability to tactically write covered calls, and we have done so in the past. But the key word there is tactically.
Yeah.
If we have a positive view on the sector or certain stocks, as we do right now, I'm quite bullish on healthcare and the outlook over the next few years. We really don't want to give away the upside on our long holdings. We want to make sure that if stocks are going up and if our names are running, then we want to capture that upside and kind of see the growth in the capital appreciation rather than capping it with covered calls, which can sometimes happen. So over the last couple of years, where the healthcare specifically has kind of gone sideways for 2 years, covered call strategies have been great. They've really performed well. They've been able to generate high levels, consistent income. But we think right now it's a great time to be owning more of a total return product where you're getting the steady income from the dividends, about, as you mentioned, 5% per year paid monthly. And you also get some of that upside from capital appreciation as the stock prices go up.
Yeah, like the chart showed, it's nice and green there, very steadily on the upward trend. And you guys have never reduced the distribution. It's always been 5 cents a month, as far as I could tell, going back all the way to probably when you converted to the ETF. So, yeah, very interesting choice. If, some of my viewers, obviously we love the covered calls, but, 5% is not too shabby at all for a defensive sector. So this is interesting because you have pretty decent yield of 5%. You have some growth as well, and you have defense. It's almost like a trifecta for people who are looking for all those three things, which a lot of my audience is, because they tend to be people who are, about to retire or retired already. So this is a great way to get in a defensive sector, get a really, really nice yield, great performance, great stock chart, and defensive sector. So I'm really liking this. So obviously you guys are doing a great job. So Robert, that's all the questions I have regarding this ETF. It's a pretty straightforward one. I just wanted to confirm that the covered call stuff, the leverage, so you confirmed that as well. So this is another one, another dividend focused ETF. I'm talking to my audience here. So they have an innovation one, there's a healthcare one, there's a real estate one, there's I think a U.S. dividend one, and a sustainable infrastructure real estate one, if I'm not correct. So I encourage my audience to check out the ETFs in case you want some yield, but you want growth. You don't want those covered calls. You don't want to cap your growth. I feel Middlefield has really great options. I think, oh yeah, you even have a global dividend one, which is also pretty cool. So hopefully I get to talk to all the portfolio managers of these ETFs. I really like talking to you guys, and these are really some cool ETFs to consider. So Robert, unless you have anything else you want to add, I am good to close off.
Nope, that's great. Just closing word, I think healthcare is a great sector to own over the long term. It's kind of an all-weather sector, and right now, just with the demographic tailwinds and the way the market's behaving, it's just a good story that's getting better. So encourage you to take a look.
Yeah, I agree. To me, this seems like it's really really is the ultimate defensive sector. Does interest rate going up doesn't seem like it affects these companies like they do utilities? Maybe a last question. Why do you think that is? Are they just so big and maybe they don't borrow as much money? I'm not sure. Maybe you
Yeah, I'd
probably
say
know
the biggest reason utilities are inherently quite leveraged. They have
Okay.
more debt on their balance sheets. A lot of, for example, there's biotech stocks that have net cash positions. They have no debt or they have positive cash. So the biggest reason that a sector like utilities is so rate sensitive is because of the leverage that they carry. And healthcare companies typically they do have some leverage, but much less than a sector like utilities or real estate, for example.
Makes sense. Makes sense. Well, Robert, thanks so much for your time. I encourage my audience to go check this one out. This healthcare dividend ETF, 5% plus, not too shabby. I just checked. It's basically outperforming all the covered call ones, right? In case you're interested, not a surprise because these stocks are slowly going up. So check it out. And Robert, and to you guys at Middlefield, thanks again for your time. Much appreciated. Hope to talk to you soon.
You as well. Thanks for having me.
Take care.